Most people think investing is about intelligence, about knowing more than everyone else, about spotting the next big thing before it explodes. But the older I get, the more I realize that the real edge has nothing to do with information and everything to do with identity. And I wish someone had sat me down in my 20s, looked me in the eye, and told me this simple truth. You don't need to invest like a genius. You need to invest like a monk. Because when I was younger, I chased noise. I checked my portfolio every day. I let headlines dictate my mood. If the market was green, I felt smart. If it was red, I felt behind. And I told myself that was normal, that caring meant I was serious, that stress meant I was ambitious. But stress isn't strategy. Reacting isn't discipline. And ambition without emotional control is just expensive anxiety. I used to believe the people who won in markets were the boldest, the most aggressive, the ones taking big swings. Now I understand that most real wealth is built quietly by people who look almost boring from the outside. They aren't rushing. They aren't predicting recessions every 6 months. They aren't screenshotting gains. They're just sitting there, calmly adding to positions, letting time do what time has always done. And that's why the monk metaphor matters. When you think of a monk, you think of someone detached from chaos, someone who doesn't chase every impulse, someone who understands that discipline is freedom. And investing at its core is a test of detachment. The market will offer you 1,000 emotional triggers. It will tempt you with greed when things are rising and infect you with fear when they fall. It will make you feel late, early, behind, brilliant, all within the same week. And if your identity is fragile, if your confidence is tied to short-term movement, you will react. You will tinker. You will override your own plan. I did this more times than I can count. I'd tell myself I was long-term, then panic sell after a correction. I'd say I believed in compounding, then shift strategies because someone on social media sounded convincing. I wasn't investing, I was coping. And coping is expensive. What changed for me wasn't a new stock or a secret strategy. It was a shift in posture. I stopped asking, what should I buy next? And started asking, who do I need to become to let this work? Because compounding doesn't just require capital. It requires temperament. It requires patience that feels almost unnatural in a world built on stimulation. It requires the ability to do nothing when doing nothing feels irresponsible, and that is deeply uncomfortable at first. We are wired to act. When markets drop, action feels productive. When friends brag about gains, action feels necessary. When news anchors scream about uncertainty, action feels protective. But often the most profitable move is stillness. That's the monk mindset. Stillness not because you don't care, but because you understand the bigger arc. Think about it. A monk doesn't wake up every day reinventing his philosophy. He follows a structure. He repeats rituals. He trusts the process. And investing done well looks almost identical. You automate contributions. You reduce decision frequency. You build a system that operates even when your emotions fluctuate. You accept that volatility is not an emergency. You stop personalizing market movements. The market is not judging you. It is not rewarding or punishing you. It is simply moving. And your job is not to outsmart it daily. Your job is to endure it long enough for probability to tilt in your favor. When I look back at my 20s, I don't regret starting late. I regret not committing deeply enough to simplicity. I regret believing complexity meant sophistication. I regret thinking I needed to optimize every variable before I could begin. The truth is, the blueprint is not complicated. Earn consistently. Spend below your means. Invest regularly into broad productive assets. Avoid unnecessary debt. Extend your time horizon. Protect your psychology. Repeat. That's it. But simple does not mean easy. The difficulty is not in understanding the blueprint. The difficulty is in executing it without deviation for decades. And deviation is seductive. There will always be a new asset class promising acceleration. There will always be someone who made more than you in less time. There will always be narratives about why this time is different. The monk hears the noise but does not chase it. The monk understands that comparison erodes clarity. When I started focusing less on outperforming others and more on outperforming my own impulses, everything changed. My returns improved, not because I found better investments, but because I made fewer emotional mistakes. I stopped interrupting compounding. I stopped resetting my own progress. And here's the deeper shift that no one talks about. Investing like a monk is not just about money. It reshapes how you live. When you detach from short-term swings, you detach from short-term validation. You stop tying your worth to your net worth. You stop checking apps for reassurance. You build confidence in silence. And that silence creates space. Space to think clearly. Space to make decisions based on values rather than fear. Space to choose long-term stability over short-term status. In my 20s, I thought wealth would change how I felt. I thought once the numbers were big enough, the anxiety would disappear. But numbers don't remove insecurity. Structure does. Identity does. And the monk mindset is fundamentally about identity. It's deciding that you are someone who does not panic. You are someone who does not speculate. You are someone who builds slowly and deliberately. That identity then informs behavior, and behavior repeated over time becomes outcome. Most people try to hack the outcome without changing the identity. They want higher returns without higher discipline. They want freedom without restraint. They want acceleration without patience. But markets don't reward urgency. They reward endurance. And endurance is emotional. It is waking up during a downturn and contributing anyway. It is holding through boredom when nothing exciting is happening. It is ignoring predictions and sticking to principles. I remember one particular market correction where everything felt uncertain. Headlines were bleak. Social feeds were panicked. My old self would have sold. My old self would have convinced himself he was being prudent. But instead I sat there and did nothing. I kept investing. And that was the moment I realized the power of emotional insulation. Because when the recovery came, and it always eventually does, I was positioned. Not because I predicted it, but because I didn't abandon the process. That's the hidden edge, not foresight, but fortitude. And fortitude is built in advance. You don't suddenly become calm during volatility. You practice calm during stability. You define your strategy when you are rational so that you don't improvise when you are emotional. You lower your lifestyle overhead so that downturns feel survivable. You build cash reserves so that you are never forced to liquidate at the worst time. You simplify your portfolio so that you actually understand what you own. These are not flashy moves. They are quiet safeguards. And over time, they compound just as powerfully as returns. The irony is that investing like a monk often leads to better financial performance than trying to outthink the market. Lower fees, fewer trades, less tax leakage, more time in the market. All of these advantages stack. But the real gift is psychological stability. You stop riding emotional roller coasters. You stop feeling behind every time someone posts a win. You stop reacting to every economic update. And that stability spills into other areas of life. You make career decisions from a place of strength, not desperation. You negotiate better because you are not financially fragile. You sleep better because you are not overexposed. You choose experiences because you want them, not because you are compensating. The monk mindset is not about deprivation. It is about intentionality. It is understanding that saying no to impulse is saying yes to autonomy. It is realizing that wealth is not built in explosive bursts, but in disciplined deposits. And deposits require consistency more than brilliance. I used to think I needed to feel motivated to invest. Now I understand that motivation is irrelevant. Systems matter more. Automatic transfers matter more. Asset allocation matters more. Reducing friction matters more. The monk does not rely on mood. He relies on ritual. And investing should be ritualistic. Every month, regardless of sentiment, money moves into productive assets. Every year, regardless of headlines, the plan is reviewed calmly. Every decade, regardless of noise, the horizon extends. When you operate this way, volatility becomes background noise rather than existential threat. And slowly, almost invisibly, something profound happens. Your confidence shifts from outcomes to process. You stop asking, did I beat the market this year? And start asking, did I execute my plan? That shift sounds subtle, but it changes everything. Because process is within your control. Markets are not. And peace lives on the side of what you can control. If I could go back and speak to my younger self, I wouldn't hand him stock tips. I would hand him a philosophy. I would tell him to focus less on speed and more on durability. I would tell him that missing a rally is not fatal, but abandoning a plan is. I would tell him that the loudest voices are rarely the wealthiest over the long run. And I would remind him that compounding is not just mathematical, it is behavioral. Every calm decision compounds. Every avoided mistake compounds. Every year of consistency compounds. And one day you look up and realize that what felt slow was actually exponential. That's the final lesson most people miss. The monk does not chase exponential growth. He commits to linear discipline. And linear discipline over long periods produces exponential outcomes. It doesn't feel dramatic in the moment. It feels repetitive. It feels uneventful. But uneventful is underrated. Uneventful means stable. Uneventful means predictable. Uneventful means you are not constantly repairing damage from emotional decisions. When you invest like a monk, you remove drama from your financial life. And drama is expensive. So if you are in your 20s or even your 30s and you feel pressure to move faster, to catch up, to optimize everything at once, pause. Speed is seductive, but fragility hides inside it. Build resilience first. Lower your fixed costs. Build your savings rate. Automate your investments. Choose broad, productive assets. Commit to decades, not months. And then practice detachment. Because the real battle is not against the market, it is against your own impulses. Win that battle and the rest becomes manageable. Lose that battle and even the best strategy won't save you. Investing like a monk is not about rejecting ambition. It is about refining it. It is about wanting wealth badly enough that you are willing to be patient. It is about understanding that freedom is built slowly, quietly, almost invisibly. And when you finally reach a point where your portfolio grows more in a day than you used to save in a month, you will realize something humbling. The growth didn't come from brilliance. It came from restraint. It came from consistency. It came from years of choosing discipline over impulse. And that is why, if I had to summarize everything I have learned into one sentence, it would be this. Don't invest like you're trying to impress the world. Invest like you're trying to outlast it. And here's the part I wish I understood even earlier, the part that sits beneath all of this and quietly determines whether the monk mindset is even possible in the first place. Because discipline in investing is not built in the brokerage account, it is built in your lifestyle. In my early 20s, I focused almost entirely on returns, on percentages, on asset allocation splits, on which ETF was slightly more efficient, but I barely paid attention to the structure of my own life. I didn't realize that your investing psychology is downstream from your financial margin. When your expenses are high relative to your income, when your lifestyle is stretched, when your identity is tied to maintaining appearances, you cannot invest like a monk because you are fragile. Every downturn feels threatening. Every correction feels personal. Every job risk feels catastrophic. And fragility forces reaction. The calm investor is usually the one with breathing room, the one with lower fixed costs, the one with an emergency fund, the one who does not need the market to cooperate this year in order to survive. That is not luck. That is design. And once I understood that, my focus shifted from chasing higher returns to increasing resilience. I started asking different questions, not how can I earn an extra 2%, but how can I lower my required monthly expenses? Not which stock will outperform, but how can I increase my savings rate without feeling deprived? Not how do I optimize this quarter, but how do I make the next 10 years almost automatic? And that shift created something powerful: optionality. When your life costs less than you earn by a meaningful margin, you gain negotiating power at work. You gain the ability to walk away from environments that drain you. You gain patience in downturns because you are not cornered. Optionality is the hidden dividend of disciplined living. It doesn't show up in your portfolio balance immediately, but it compounds in confidence. And confidence changes behavior. You stop chasing speculative upside because you are no longer desperate for acceleration. You stop comparing your timeline to others because you are secure in your structure. You stop overexposing yourself to risk because you understand that survival is the first priority. Most financial advice focuses on assets. Very little focuses on overhead, but overhead determines endurance. If your cost of living expands every time your income rises, you trap yourself in a cycle where you must always perform at a high level just to maintain stability. That is not freedom. That is a high-income version of fragility. The monk mindset requires lowering the baseline of what you need. It requires defining enough before the world defines it for you. And once you do that, something subtle shifts inside you. Market volatility feels smaller because your life is stable. Headlines feel less urgent because your foundation is strong. You realize that wealth is not just about the size of your portfolio, but about the size of the gap between what you earn and what you require. That gap is where investing power lives. That gap is where calm comes from. And protecting that gap becomes more important than maximizing any single return. Over time, I began to see investing less as a pursuit of more and more as a practice of alignment. Aligning my spending with my values. Aligning my investments with long-term productivity. Aligning my identity with patience rather than ego. And when those alignments lock in, decisions become easier. You no longer need constant motivation because your environment supports your philosophy. You no longer need willpower to avoid impulse purchases because your priorities are clear. You no longer need to monitor markets obsessively because your plan is simple and durable. This is the deeper blueprint, not a secret stock, not a hidden asset class, but a structure that makes disciplined investing the default rather than the exception. And when discipline becomes default, compounding becomes inevitable. It may not feel dramatic day to day. It may not provide social media moments. But years later, it provides something far more valuable: stability, autonomy, and quiet confidence. And that, more than any return percentage, is what I truly wish I had optimized earlier.